Good evening, viewers. Today we are proceeding with our series on impairment of assets, that is IAS 36. It's impairment of assets. And before we go any further, I wanted to first give you some of the items that are not considered, or we look at the scope. But we are going to look at the scope in the other way around. We are going to see the things that are not supposed to be included within, or that are not catered for under IAS 36. Then the rest will be, because they are very few, they are around 9 or 8. So when we get those ones away, we can be able to understand. One of them we have inventory. Inventory is supposed to be catered for under IAS 2, as we saw it earlier. Then we have constructive, living from construction contracts. That is. Then we have the biological assets, IAS 41. Then we have assets that are held for sale, that is IAS 5. We have deferred tax assets, that is IAS 12. We have financial instruments, those are bonds, shares, that's IFRS 9. We have assets from insurance contract. We have assets that arise from employee benefit, that is IAS 19. We have investment properties, that is IAS 40. And basically those are the ones which are out of the scope of IAS 36. So the rest, just know they are supposed to be included. So when we try to look at impairment, is basically the loss in value of assets. These are just loss in value, whereby the carrying amount of the asset is higher than the recoverable amount. It's like you have an asset which costed let's say 10 million, but what you can only get from the market is 8 million, meaning that difference is going to be the impairment. We said, like when we are talking about the intangible asset, we said even the players, they can lose the value, they can go for impairment. Someone is not performing well, we find that the person who bought 100 million, and I gave an example of, let's say, Pogba, Lukaku, the likes of Sancho, but at the moment when you try to get some money that can come out from after selling those players, you find that they are not worth it. They impaired, because they can't give you the money you give out, even if you've kept some amortization somewhere for each year of their contracts. But that's basically what we can talk about, maybe to give you some brief definitions which we are going to be using within the scope. One, the carrying amount. We said we've been talking about the thing. Carrying amount is the amount that is owed, is the net book value that is found in the balance sheet, which is the value in use that appears in the balance sheet. That is the net book value. It comes as a result of getting the cost with less accumulated depreciation and impairment losses. Of course, we are going to be seeing them. It is impairment because I had reserved this since it had its own standard. So that's how we get then maybe talking about depreciation. You are spreading depreciation. You are spreading the value of the asset over its useful life. You'll be writing off at least every year. You'll be writing off a certain amount. but the whole cost is spread throughout its useful life of the asset. Then the other one we spoke about, the recoverable amount. Recoverable amount is actually the amount you can get from the fair value you can get from the market less the cost to sell. That is basically the recoverable amount, or the value. Basically this standard says it gives it in two ways. It is either the fair value you are going to get from the market, you less the cost to sell, and those costs to sell, they may be in terms of transport, because when you are selling the asset you incur transport, taking it to the market, advertising, commission to sales agent, and all that. You less it. What you remain with will be the recoverable amount. Then the other way is talking about it in terms of the value in use. The value in use here, we are meaning the entity specific value. That's another term you can use if at all you don't call them value in use. But value in use, we are saying that if at all you are not going to sell this asset, how much can you get from the asset after looking at the cash flows that asset can give you throughout its remaining useful life of that asset. So that's basically what we are talking about, the value in use. So as per this standard, the standard says if you are to recognize the recoverable amount, you should recognize either the fair value less the cost to sell, or the value in use, but you take the one which is higher of the two. If you get the fair value less cost to sell, and which is higher than the value in use, of course we are going to be seeing how we are computing these figures. Of course you get the estimated market price, you less the cost of sale. Then the value in use, of course you look at the cash flows we are expecting to get from that asset if at all we are not going to sell it. So if we are getting those future cash flows, remember we are just expecting to get them in the future. It means we have to look at their present value now. What is its present worth now? Meaning we are bringing in the component of discounting, like what we did in the first video, because we looked at how to discount these cash flows and we looked at how we determine the present value. Hope you can be able to remember those ones. If at all you see it is a bit confusing or challenging, you try to go through the first video which we started with, the elements and the measurement bases for elements of financial statements, because we spoke about them and we did some computations, so that it wasn't just for fun, but it was going to be useful into our presentations. So having known the items that are supposed to be out of the scope, then maybe the last one I can talk about is the cash generating unit. And we said these cash generating units, they are just they are small identifiable group of assets that can generate income on their own. They don't need to get, they are not like these other assets which get their incomes through maybe waiting for the production to occur and they see how much they can get from there. But this one you can get the cash flows independently from them. They are identifiable. We said identifiable, they are capable of being sold or rented out separately. So those are the things we are going to be looking at, as far as the terminologies we are going to be looking at in the due course. So we can try to go through the notes and we see what we have. We are saying impairment refers to the fall in value of the asset, and that is its carrying amount being higher than the recoverable amount. We spoke about the recoverable amount. And we are saying the carrying amount refers to the value of the asset in the balance sheet, what we normally record as the net book value of the asset in the balance sheet. So the recoverable amount, we are saying it is the higher of the fair value less cost to sell, or the price to be received from the sale of the asset less cost to sell, or the value in use, that is the present value of the future cash flows expected from the asset. If they are future cash flows, it means we want to know how much are they now. We discount them and we get their present worth. That will be the value in use. We compare which one is higher, then we take that as the recoverable amount. So having seen those ones, then we can look at the measurement. We can look at how we measure these impairment losses, and we'll be able to understand. Of course, you know the recognition criteria is that to recognize that there is an impairment, it means the asset has reduced value. That one is, we get it from the definition. Then we are saying that when the carrying amount of the asset exceeds the recoverable amount, then that difference will be taken to the profit and loss. The reason why we are taking it to the profit and loss is, one, we are using the fair value. I said earlier that the only thing we take to OCI or the statement of other comprehensive income is that those are the revaluations. Those revaluations, they are actually not realized, but this one they are realized because we are comparing with the market value. That's basically what you can pick from the market currently. That's why the differences are going to be taken to the profit and loss account. That's in the names of impairment loss. By debit, we debit the profit and loss, then we create the asset. The reason why we are creating the asset, because the assets are going to be reducing in value. Because by all means, when we are recording these assets, we have to record them at their recoverable amount, whether it is high, whether it is low. It's supposed to be recorded at their. If we do the remeasurement, we have to record at the new fair value remeasurement, or whichever figure we shall be getting as the recoverable amount. So having known those ones, we can proceed maybe to the next slide, and we'll try to look at what is there for us. We have a simulation. There is a simulation there, of which this one I'm not going to let me first take you through the computations, the theoretical aspect, so that we'll be able to, but this one is only testing about but you know how to get this. I taught you how to get the present value. You can get this, but I've given you the impairment is this, and the recoverable amount is this. Of course, we say the recoverable amount, we compare the fair value, and they are saying here, maybe to give you just a brief view, they are saying the machine has a carrying amount of 900,000. I did not put the units, but you can put any whichever country you are watching it from. It has a carrying amount of 900,000, and it is estimated to generate cash flows. These are the ones we are going to get. The cumulative cash flows of it is 220,000 per month, per annum, for every year from year 1 to year 5. It means we are getting 220 for every year for 5 years. And now they are saying the fair value, this one is supposed to be the fair value. The fair value less cost to sell is 660,000. They have given us the discount rate, and they are saying they want us to know whether the asset is impaired or not. What we said is that we discount, first of all, we discount this amount But since we are getting a constant amount, we are going to use the annuity tables. Sorry, the annuity factor. Either you may use the annuity table, you get the what will be the annuity for the 5th year, then you multiply by this, you compare the figure you are going to get from this with this. And when since here I took the recoverable amount to be 773, it means this amount was higher than this. So it means we take the higher, which in this case we took this, meaning this amount was higher than this one. You get this, you multiply by the annuity factor, or you can discount it yearly and you use the discounting factor, then you sum up, you get the present value, you compare with this. Then having got that, you compare this value with this, because this is the carrying amount at this date. Remember, we were not given years. If we were given years, we could take in the depreciation component, but we were not given. So you just compare with this. If you compare this amount with this, you'll find that we have a loss, because this is 700 something and this one is. When you get the difference, it will give you this. How do we account for this? We treat it as an expense. But subsequently, we are saying that when the asset is impaired, it will be subsequently carried at the recoverable amount, whether high, whether lower. So it means even if the carrying amount was this 900,000, but we are going to record it in the balance sheet as 7 this, because it is our recoverable amount. Then we take this. By taking this to the profit and loss, it means even if you don't do any transaction, by the time you will take this amount to the balance sheet, the net profit that you will take to the equity section will be already less by this figure. So our thing will be balancing. Hope you can be able to memorize that. Then we can try to look at, I was dodging that simulation, but we can see how we see we can look at something that is a bit new, and it's not new. We talked about it when we were talking about IAS 16, that is accounting for revaluation and impairment. There happens a scenario whereby that this asset was previously revalued upward, or we had a revaluation gain, and now the asset which increased in value for a certain time, maybe we can use this very example here. It will be able to guide us before even we go through the explanation. We are saying that an asset had a carrying amount of 10 million on this date, but on that date it was revalued at 20 million. On that date, meaning on 1st January 2020, it was revalued at 20 million. It means we had a revaluation gain of getting this difference from this. We get a revaluation gain of 10 million. So the implication is, now when they went for an impairment review, because they are saying an impairment review on 31st December, meaning at the end of the year, the asset was revalued and the recoverable amount was only 8 million. Meaning this asset previously it had a gain, because previously we recorded its cost as 20 million. But as for now, we are recognizing a loss, because at the end of the day we are recording 8 million. So how are we going to be treating this? What we do in the explanation, we can get. Remember in the first scenario, when we got the revaluation gain, we said we debit the asset, because the asset is increasing. We debit the asset by 10 million. That is the difference, because it had 10 million as the carrying amount. So when you added the 10 million, it reached to 20. You debit the asset by 10 million, then we credit the OCI, or the statement of comprehensive income, by the 10 million. So by the end of year, we had a revaluation. We did a revaluation and we found that the asset was impaired. So what will happen? We will first of all depreciate this asset to get the carrying amount for the asset as out of this. Then we compare. When we compare that, we will be able to get the value. So when we did the impairment, we found that this asset has reduced. Of course, here you may not depreciate the asset because you have not been given the useful life. You may take this as this. You leave alone the depreciation because you are not given the useful life of the asset. But if it was there, you'll be able to depreciate the asset, and you make sure you reach to the carrying amount as of this. But since it was not given, you just base on this and you get the difference. This one will be its carrying amount, then this is the recoverable amount, meaning we shall be able to get the 12 million as our impairment. But what will happen? How are we going to record this? Remember the other 10 million, we took it to the OCI. What we do, that impairment, first of all, it has to be compensated from that valuation gain. By doing the complete reversal, what we do, the other time we created the OCI, now this time around we are going to debit OCI, but we debit it with the amount, the revaluation gain which we had previously of 10 million. So this 10 million, we shall debit the OCI by 10 million, then the balance is what we shall be taking to the profit and loss as an impairment loss of 2 million. Meaning, when you are creating the asset, of course we create the asset by the 12 million because the asset has lost value. It was 20 million, now it is 8 million. Hope that one helps. And when we do these computations, you'll be able to understand more of this. But what I want you basically to get is this theoretical aspect. Then we can talk about how do we account, or how do we treat the impairment of the cash generating units. We said these cash generating units, they are small identifiable group of assets for which independent cash flows can be identified and measured. We can get their money, they can generate their own money, and we can probably measure that amount of money. So how do we see how do we account for if at all they have been impaired or not? We are saying that if it is not possible to determine the value in use of the asset or the cash flows from the asset, then a group of assets may be combined together, that's to form the cash generating units. And we are saying a cash generating unit is the smallest identifiable group of assets for which independent cash flows can be identified and measured. Remember, this is a group, it's a cash generating unit we are putting in. There are so many items. How do we deal with it? When a cash generating unit is impaired, the impairment loss will be allocated to the asset in the following order. This is the order we follow. First of all, we first give the impairment to those assets which are completely damaged. You may get a scenarios where they are saying that, let's say a certain motor vehicle involved into an accident and it got damaged, or there are so many scenarios which they may use for you to be able to identify the damages that have reached to the asset, that have gone to the asset. Because the reason why we are first giving, because those are the ones which are almost destroyed, so we first give them the impairment, Then the other one will give it to goodwill if there is any goodwill that is allocated for that cash generating unit. Then the last one, whatever is remaining, because you may find that the impairment, let's say, is 15 million, and the damaged items, they are taking, let's say, the damaged items, maybe they were for 5 million, and maybe goodwill that was allocated was 10 million, and you find that you are not remaining with anything. If you are not remaining with anything, then these other ones, you just leave them. But if the impairment is remaining, if let's say these ones are taking 5, the other one, the goodwill is taking 5, then that 5 that is remaining to make the total of 15, which was the impairment, you just get that and distribute the remaining assets on a pro rata basis. Pro rata basis means you are going to distribute according to the cost, their cost, and maybe the total, the cost of those assets that are remaining, each one over the total. Then you multiply by the remaining impairment. These ones I was just giving a brief items that are not supposed to be part of the standard. And we have a simulation. This is a simulation, a simple one you can look at. Then we have a trial number, October 2021, question 4. Let me finalize with this. I hope it is. Yeah, it's the one that is winding up our topic of impairment. Then when you do these simulations, you'll be able to get more and more, because when you are seeing figures, it will be easy for you to understand. But you need to get these concepts. They are very important. We are saying the reversal of impairment. What do we mean by saying the reversal of impairment? What happens is that there are certain scenarios whereby the asset was previously impaired, but at this time now, instead of being impaired, it is now having a gain. How do we treat that? The other one, remember, was a revaluation gain, but this one now we can't use a revaluation loss, because here the assets are going to be, it's more or less the assets are impaired. So if the assets are impaired previously, and now we are registering something that is different, how do we treat it? We are saying this arises when the recoverable amount of an asset that was previously impaired is now higher than the carrying amount. A reversal of the impairment is recognized in the profit and loss. The reason why we recognize in the profit and loss is because we are dealing with the recoverable figures, and we say these are fair value figures. So we put them in the profit and loss. And we are saying if the original loss was debited to the OCI, like the same way we did for the revaluation, if at all it was previously debited to the OCI to reduce the previous revaluation gain which you had, then we do the reversal by crediting the OCI. We are going to look at a question and we'll be able to understand most of the things, but maybe there is a note which we are saying a reversal of impairment should, however, take the value of the asset above, should not take the value of the asset above what would have had if the original impairment did not occur. What we mean here is that when you look at these assets, if the asset was previously impaired and now it is increasing in value, what are we going to be recording in the financials? We are saying it shouldn't take more value, which it would be having before even it got into that scenario being impaired. So those are the things we are going to be looking at when we do the question. And we are saying impairment loss on goodwill is not reversed. Of course, you can't, if goodwill is impaired, you don't reverse, because at the end of the day, goodwill, there is no way you can say I'm recovering the lost name. There is no way you can do that. That's why we are not reversing goodwill. Let's meet in the next video where we are going to be talking about these but there is a simulation. We are going to look at it in the due course, and we'll be able to understand more about it. But I urge you guys to subscribe to the channel so that we can be able to learn more, because when I start these simulations, you'll be able to pick a lot, and I will be explaining more and more when you are seeing the figures. Thank you.